Can a nonprofit organization own a for-profit business? The answer might surprise you. Nonprofits can indeed own for-profit businesses, but there are important legal and tax considerations to keep in mind. Nonprofits often struggle to generate enough income to sustain their operations, especially during challenging economic times. Owning a for-profit business can be a solution to this problem, providing a new revenue stream to support the nonprofit's mission. There are two main ways nonprofits can work with for-profits. In one scenario, the nonprofit controls 51% of the for-profit's operations, with significant overlap in leadership. Alternatively, the nonprofit and for-profit can be separate entities that interact through mutually beneficial contracts. The Internal Revenue Service, or IRS, allows nonprofits to own for-profit businesses under certain conditions. The for-profit must support the nonprofit's exempt purposes, and its earnings must be used to further the nonprofit's mission. It's crucial that these activities do not constitute substantial unrelated business income, which could jeopardize the nonprofit's tax-exempt status. For example, an art museum could sell reproductions of paintings, or a hospital could sell disease-tracking technology. These activities align with their respective missions. However, too much profit from unrelated activities could attract unwanted attention from the IRS. When structuring a for-profit subsidiary, most nonprofits opt for a C corporation or an LLC, taxed as a corporation. This structure optimizes taxes and protects the nonprofit from legal liability. It's important to note that dividends distributed from the for-profit to the nonprofit are generally tax-free. To maintain the separation between the nonprofit and its for-profit subsidiary, certain best practices should be followed. The two entities should have separate bookkeeping, meetings, and tax returns. They should also sign documents in their own corporate names. The nonprofit should control its subsidiary through voting power to elect and remove directors, but should avoid managing day-to-day operations. While there can be overlap in the boards of directors, it's advisable to have some outside directors as well. Any transactions between the nonprofit and for-profit should be documented and approved by the board of directors. Owning a for-profit business can benefit a nonprofit in several ways. It can diversify revenue streams, expand the nonprofit's mission, provide liability protection, and enhance credibility. However, it's crucial to navigate the tax implications carefully. Nonprofits may be subject to unrelated business income tax, or UBIT, on income not directly related to their exempt purposes. Proper structuring and documentation can help minimize this tax burden. There are also legal risks to consider, particularly if a nonprofit wants to act as a general partner in a for-profit partnership. The IRS applies strict tests to ensure such arrangements align with the nonprofit's exempt purpose and do not compromise its priorities. In conclusion, while nonprofits can own for-profit businesses, it's a complex arrangement that requires careful planning and management. By maintaining clear boundaries, implementing independent governance, and ensuring compliance with tax and corporate laws, nonprofits can successfully leverage for-profit subsidiaries to support their charitable missions. As always, it's advisable to consult with legal and tax professionals to navigate these complexities effectively.